Hello, everyone. Welcome to yet another episode of Punch Card Investing. Brad is still in Turkey, doing some due diligence on racists, most likely. But glad to see that we have four here today, since we had a couple of weeks in a row of three people. So we're almost back up to our usual five. We'll be back there in no time, so don't you guys worry. But in any event, before we dive into today's episode, talking about overvalued companies, which is really kind of that's kind of like the normal state of things in value investing, is that many things are overvalued, at least in your own sort of perspective as you're trying to value companies. And it's when you come across those undervalued ones that you get really excited, but those can be pretty rare depending on your criteria. Of course, if you lower the bar, you're going to find a lot less overvalued stuff. Beauty is in the eye of the beholder. But anyways, before we get into that, be sure to smash that like button, since we definitely need the help. Always could use your help. And it helps the channel grow and reach out to new people who are interested in value investing. And we've really loved the fact that we just passed 2,000 subscribers, and we couldn't have done it without your guys' help. And don't think that we're stopping there. We're trying to compound this channel too, in addition to our portfolios. So be sure to subscribe if you haven't already. And if you want to see more content about value investing, and if you have ideas for topics, we have that Discord down in the description below to join that as well if you're not already in there. And that was kind of the inspiration for this topic. So we had someone talk about how they wanted us to go over kind of overvalued companies and kind of our perspective there. So thanks to the Discord for that one. And there's a lot of good questions and conversations in there as well. So definitely worth joining if you haven't already. All right, let's get into it. Overvalued stocks, where to begin? I guess we could just maybe throw out some examples, or kind of who wants to lead off with that one?
I can start off if you want.
Go for it.
So the company, this one I've been looking at since kind of just after the pandemic, when prices were cheap, and it kind of got to the point where I really did think about buying it. I was looking kind of for a COVID play, some kind of beneficiary moving out, which I ended up going with Twitter at the time, was kind of my version of doing so. But the company I really like the most and would love to own is Sea Limited, which actually, from the point I was looking at it, is up about 450 or 500%, something crazy like that. So obviously it's a pricey stock. Just by moving up that much, you can tell it's probably overvalued. It trades at about 25 times sales roughly at the moment. But if you don't know what it is, it's a company that operates out of Singapore. C, as in SEA, stands for Southeast Asia. That's where they operate most of their businesses. And they have a big branch of the business does gaming. They have a company called Garena, as in Gaming Arena. Then they have like a e-commerce business similar to like an Amazon type business called Shopee, which operates mostly in Southeast Asia as well as Brazil now as well. And then they have like a fintech payments type business similar to maybe a PayPal, which is called Sea Money. And they've just announced that they're moving into an artificial intelligence branch as well as a venture capital fund. So kind of like a Tencent type business is probably the best comparison I have for it. A lot of what they do is similar to Tencent. They kind of, all their profits come from their gaming branch of the business, and they use that to fund their fintech and e-commerce business, which at the moment are unprofitable. Overall, the business is still unprofitable, but they have a lot of operating leverage kind of kicking in. And as they scale, they really are going to reach a point of profitability very soon. They've just had positive free cash flow numbers, but their earnings is still negative at the moment. They're about $175 billion company last time I checked, and still growing at 100% each year. So the past 3 or 4 years, I think they've grown at 100% top line. And their returns have been well beyond that, like I said, 500% over the past 12 months. Beast of a company, Tencent owns 20% of it, which is part of the reason I like Tencent, is because you have this huge value of a growing, fast-growing business like Sea Limited hidden within Tencent. The CEO and founder of the business, Forrest Lee, I think his name is, he owns about a quarter of the business as well, so about 50% of the shares, so a lot of skin in the game. But everything about it, I love. It's a great business. I think it's going to be very profitable very soon with high margins as well. everything except for the price, which is the only reason I've kind of stayed away from this one. 25 times sales, which can almost be justified, not for me, not for my type of investing. But if it continues growth rates, say at, I think the number that was 35% over the next 5 years, if they can grow their top line at that, and their price to sales ratio halved, so from 25 down to about 12 or so, then you would still double your money over 5 years. So a pretty decent return with probably lower growth than it could have. And we might not actually see that multiple drop so much. So there's an argument to say that, well, the growth investors would make an argument that it's not overvalued because of the growth, but it's just not my type of investment. Have any of you guys looked into C or interested in it at all?
Not me
Not really,
personally.
no. But at 25 times sales, it's way cheaper than like Palantir. So seems like a bargain, you know.
It seems like anything's cheaper than Palantir based on that metric.
Yeah, 25 times sales is hard to justify, but when it's growing at 100%, that's where it kind of can almost get reasonable. But yeah, it's not something that I.
You need a lot to go right there, though. If they hit any hiccup, we're talking about 100% growth that you're kind of relying on happening. Even if they do pretty phenomenal at 50% growth, that's half of what you were anticipating. So when it comes to lofty growth projections, you got a pretty substantial room for error, depending on how aggressive you're getting at with your valuation. And I think that you're kind of getting at it based on your own standards, Frank. Like, that's a very important sort of wrinkle here when it comes to valuation in general. One person's valuation might be very different from someone else's, and they both might be totally logical and legitimate. It just depends on your investment criteria when it comes to like risk reward. Like, what is your discount rate? What's your required return? You might assume all the same things besides the actual ultimate return that you're comfortable pulling the trigger on. So like, that's definitely one thing to kind of weave in through all of this, in that our valuations aren't fact. It's certainly not financial advice. Your valuation might be very different based on your own investment criteria. So you definitely want to do your own sort of analysis, because everyone's in a different position. And even taking all the same facts, you can come to very different conclusions of whether or not to invest in any company. So just thought I'd throw that in there.
So what made you pass on it, Frank? Was it purely valuation, or were there other things that you couldn't wrap your head around at the time? Or
it was valuation and dilution, and I underestimated the growth. So the factor of those three things just made me underestimate it dramatically. But I didn't think that it was possible to grow at 100% again, even the past 12 months, but they did that with ease. I think analyst expectations were about 100%, and they outdid that to about 114%, which is pretty insane. I didn't realize how possible that was for a company that was already so large. And I wasn't sure what the multiple would do. Like, it was already trading, even at that point, at I think maybe 15 times sales or so. It was still very expensive. But yeah, between valuation, dilution, and underestimating the growth was the reason for passing.
mm-hmm.
Your Twitter
they're
investment
moving
has
along
done
the
well, though.
chessboard very fast.
So what was that? Sorry, Karan?
Your Twitter investment, which you picked instead of C, I mean, it's done pretty well, right, so far. It's up to
I won't
X3.
complain. Yeah, it's about 100% return compared to the 500 or 600% I could have had on C, but I won't complain with the Twitter return.
Yeah.
Very nice.
That's the thing about some of these investments, in that, like, you could easily say it's overvalued, overpriced, but then it goes on a run and triples from there in a matter of months, and you're like, what's going on? It's just kind of like the Buffett quote: the market can stay irrational longer than you can stay solvent, kind of like an anti-short selling quote. Because of that, like, short-term things can get pretty wild in either direction, really. But at least lately, we've seen a lot more towards the uptrend rather than the downtrend.
Next
All
business.
right, now what?
I can take the next one if you like.
Go for it.
I've just been like furiously opening up different tabs here that I might try and share, just because ticker seems to be down for some reason. But we'll
Yeah, I was trying to pull up C Limited, but ticker's not loading market data, which is a shame. All right, Tom, I
Yeah.
see your screen.
Is that coming through?
Yeah.
You got me now?
Ticker is so good, like we've forgotten every other platform. It's just like,
Yeah,
what are
really.
the other platforms like?
Cool. Are you guys seeing a stock chart?
Yep.
Okay, great. Right. So, the company I'm going to talk about is Xero. Xero is spelled Xero. So, unless you're in New Zealand and Australia, I'm guessing you probably haven't heard of this company before. But I guess when we think about businesses we would like to own, I always sort of go back to the Buffett quote of like, how do we identify great businesses? So he defines a great business as one that earns a high return on capital. He describes a really good business as one that earns a high return on capital and grows. And then I guess if you take that a step further, the like perfect business is one that earns a high return on capital, grows, and basically needs little to no capital to kind of achieve that growth. So that sort of naturally leads you in a lot of cases, I think, to software. And that's why I've chosen Xero. So Xero is basically an accounting business. It's one I've sort of admired from afar for a little while, and was probably too dumb to see the potential opportunity a few years back when it wasn't really profitable. And yeah, it's been a crazy home run. It used to be dually listed on both the NZX here in New Zealand and the ASX, and they're just purely listed on the ASX now in Australia. So great business. If we're talking about overvalued, it's currently trading at 26 times sales, basically 30 times book. Not that that really matters for software companies, like we talked about a bit in our valuation episode. And I think a PE of 1130 right now. So that is on a very small earnings base, I must say. So none of those individual metrics really probably mean a huge amount besides perhaps like the price to sales. Basically they're a subscription business. I was hoping to pull up some of their long-term growth on Ticker, like I say, but hopefully you can see this little chart in the bottom right here of Yahoo Finance.
Yep.
That's about as close as I'm going to be able to get. So revenue has been growing extremely fast. So basically it's like a monthly subscription type software for small businesses, so they can do all the invoicing really straightforward, produce financial statements. Also Xero sell various like add-ons to the base subscription where you can do like your payroll and that sort of thing. And it's actually the accounting system that the company that I work in my day job uses. So I'm fairly familiar with the product as well. And for a long time, Xero caught a lot of flack. So you'll see in the earnings here, if you can make out those little blue sections, they're kind of only just getting to profitability in the last year or two. That's why I sort of mentioned the PE ratio probably doesn't make too much sense as like a valuation metric because it's a very low base.
Is all the money just going towards like marketing expenses? Because it's software, so like I doubt it's a massive capital thing. Is it just pure marketing?
Yeah, it's interesting. If you look at the balance sheet for Xero, they're basically at about zero in terms of net cash, so they have about the same debt as cash. So I think, to be honest, it's been so expensive that I've just passed very quickly and haven't done a lot of deep work on Xero. But I expect it's largely going towards marketing, like they're running ads all the time and on TV in New Zealand, and I'm not sure if you see that in Australia as well, Frank. But they are kind of popping up everywhere. So I expect they're like over most of the hurdles in terms of their actual software development. So probably is just going to things like marketing and trying to grow.
Because my question would be, is this really a great business? Or is it just like a great brand? But I mean, it's hardly profitable for all the revenue they're bringing in. I don't know if their earnings are going to explode over the next few years. It could happen. You'd probably know better than I would at this point, but
I think
go ahead.
I think it's a good example of a business that has a very sticky product. Like it's not a lot of businesses are going to spend the time getting set up with an accounting package and then they're going to switch over to the next accounting software the next year because Xero pushed the price up a little bit or whatever. And I pulled up some of their subscription models before. So these are sort of the monthly prices in New Zealand. They're charging about $60 a month before some of the add-ons you can do. So it's hardly like a major cost for most businesses. So I expect it's pretty sticky revenue, to be honest. And I think although there might be a lot of marketing to kind of get to scale, I can see this thing producing a lot of cash, to be honest.
How does that pricing compare to other systems? That does seem very cheap, just in my limited understanding of like accounting software and that sort of stuff.
Yeah, good question. It's probably something I'd have to dig more into.
Sure.
I
know.
Off the top of my head.
Given the price, it's not worth all the research, but
yeah, it's one of those things. Yeah, I actually know someone who invested 6 figures in Xero a decade ago, and they're a very happy man right now. So it's one I have admired from afar, but have kind of not dug too deep into just yet. But one of the other things I thought I'd share on Xero is I think with a lot of good businesses.
Could you zoom in a little bit on that, on the income statement?
Yeah, sure.
Yeah, there you go.
I think with a lot of good businesses, or maybe I should flip this the other way around, with a lot of really poor businesses or incredibly complicated businesses, you often see really complex financial statements as well, which are can be a bit of a nightmare to actually figure out what's going on. and Xero are kind of the complete opposite of that. Like they have very, very basic financial statements because they basically just bring in subscription revenue as the vast majority of the revenue. As you can see, they've got fairly minimal expense items. Actually, this kind of answers your question before, Jack.
Yeah.
A lot of money going towards sales and marketing.
A third, basically. Which so wait, so if a third is towards marketing, what's everything else then? Just labor?
So there's a lot to R&D there as well. And
what's the R&D towards? I wonder. For software.
And the marketing sales is dropping down. So they're similar position to C, where they're going to see a lot of operating leverage moving forward. They don't need to keep spending the same amount of sales and marketing.
Yeah.
And their revenues are going to continue to grow. So,
and that would challenge your assumption, or not really challenge, but test the assumption, see how sticky these revenues really are once the marketing budget goes away. You'd imagine a chunk would stay. I wonder how many, what their true conversion rate will be after, say, 5 years. So yeah, it looks like there's definitely some promise there if marketing is dropping off that much. Yeah,
for sure. I mean, marketing's gone from, let's say, 312 million to, well, it's basically held steady, and revenue's gone from 696 million to 828 million in a year. So if they can keep those kind of trends going, you start printing cash pretty quickly, I would say.
Right.
Yeah. So there you go. That's one I've admired from afar for a while. And yeah, it's just so, I was doing some very back of the envelope calculations with this one only just a couple of months back. And I was sort of assuming if this thing grows at 20 or 30% for a decade and then still trades at 40 or 50 times earnings, I was getting to pretty similar market caps, 10 years down the track to kind of what it's at today, even using pretty optimistic assumptions. So, yeah, those sorts of things kind of turn you off from looking too deep on it. But yeah, it's a really interesting company. And New Zealand and Australia don't have a lot of businesses that are growing really fast. So anytime one of these things does pop up, I think capital tends to kind of flood into it once it becomes a little more obvious where they're heading.
Right. I think this might be a good time to actually talk about what makes a great business. Because that's kind of one side of this equation here. It's great businesses that we think are overvalued, and it's probably going to be most of the great businesses out there, because it's rare that you get a great business that is undervalued, and that's what makes such a great opportunity. But what makes a great business in the first place? Are there factors you guys look at when you're? Is it just kind of a feel thing where you see a company, you're like, wow, that's a great business, and then you look more into it and learn more about the mechanics, or is it the other way around? Do you see some details and then build on that?
Yeah, the way I view it is the Buffett kind of stuff I said before, the high return on capital, and ideally high return on capital and it's growing. And I guess the other bit you'd tie into that is certainty, as a business like Xero or whatever, still going to be around in 10 or 20 or 30 or 50 years if you're Buffett, buying something to hold forever.
I think you have to kind of be careful with the return metrics to determine quality, as well as margins. Like the other good thing you can look at is how high are their margins. Something like a MasterCard or a Visa that has a 40%, that's a guess, 40% net income margin or something crazy, makes it seem like a great business, which in that case is true. But sometimes like the C Limited business or Xero as well, that's kind of hidden in the fact that they're reinvesting so much money back through the income statement, and they're spending a lot of capital to grow the business in the early stages.
Right.
So something like C Limited, I think the quality of the business comes from their moat and their competitive advantage. They're a low-cost provider in their region and everything like that. So you couldn't look at their return metrics would all be negative because they don't have positive earnings. So, and if you looked at, I'm guessing Xero as well, their return metrics are probably very low because they only have small amount of earnings compared to revenue. So yes, that is one metric you can look at, but I think the main thing to determine a quality business is the moat or the competitive advantage and how sustainable that will be for the next 5 or 10 years. So in C's case, there's no one in Southeast Asia that are going to compete to a high degree with C, particularly in gaming, maybe more so in the e-commerce space. They have some competition with Alibaba's Lazada, which is only a small part of Alibaba's business, but a pretty large competitor compared to the Shopee business, which is part of C Limited. So, but overall, I think they have a moat and a competitive advantage. They have a large part of the market share, and it's pretty easy to keep it at this point. And then you see the margins kind of improve over time as the operating leverage kicks in. And then you start to see those return metrics when it's more established, which is exactly what Amazon kind of did early on. You couldn't look at those return metrics, but you probably could have seen that they had a moat and a competitive advantage.
It's like a maturity question is what you're getting at. It's like you can invest in an immature company that's still great because you're really looking at the future of the company much more than maybe kind of the present stable cash flow. So like on the one side you have stability and predictability, like Tom mentioned, but on the other you kind of have like sort of potential and the actual growth side. So yeah, I guess you could say it's cash flow and then growth, more or less, are the two spectrums you're looking at. And the less cash flow, definitely the more growth you're going to want to see, and the more cash flow, then the less growth you're probably going to need. But in any event, you still want to get it at a great price.
Yeah, I think
to add on to, yeah, go ahead.
No, you go ahead, Karan.
Yeah, also to add on to what Jack kind of said about the maturity of the company. So with a younger company, there's a lot more dilution. And dilution doesn't matter what the growth rate is. If they just keep diluting out shareholders, like you're not going to be getting any sort of returns. And I think that's a huge component for a great investment.
Yeah, so that comes into C as well. Again, I'll push back slightly on that one. That's definitely true, but it depends if the growth outweighs the dilution. Right. I don't know how much off the top of my head C is actually diluting, but say they're diluting 20% each year, which is a huge chunk. If they're growing at 100%, that doesn't matter. But there are a lot of these other tech businesses that dilute 20% and only grow 20%, and that's extremely concerning. So you have to be very careful of that. Ideally, though, the best business would be not diluting at all and funding their growth from their own cash flows.
The company that really comes to mind is Tesla. The way they've been diluting shareholders and kind of have gone on this insane growth
Here come
trajectory.
the dislikes.
Easy dislikes. Karan, what you meant to say for the algorithm is that Tesla is the best stock ever, and we need more of it, and then we can get some likes, and then we're good.
Yeah, but when they actually, they raised debt, right? So they issued some convertible debt, and people kind of really bought that up. But I think that was a really stupid capital allocation decision, because people are willing to pay any price for Tesla stock. They should have, rather than issuing convertible bonds, taking on debt, they should have just kept selling off equity. Like that kind of matters in terms of the maturity of the company. So Tesla's still somewhat of it is still a high growth company, right? Even though they don't just make cars. I know that's the big justification.
Growth pitch.
Yeah.
Well, it could be a control thing too. Sure, it's convertible, but I'm sure there's some terms in there that or for some reason it was more important to keep control, and money's so cheap right now, relatively speaking, that.
But they still raise money through equity, even after the
Well,
dilution.
as it kept going up and up and up and up and up, eventually, like, your hand's kind of forced. So
It's even
Yeah,
higher than what it was when they were selling.
they like couldn't keep it. They couldn't stop it, pretty much.
Yeah, they should have issued more. That's good capital allocation to start issuing shares when price gets that high.
Like they never need capital again, I think. They'll never have to sell any equity or raise any debt.
Hot take.
I like it. The other thing I'll just quickly add on, I guess, great businesses. I think a nice, like there's a long list of stuff we can talk through about, like the durability of their moat and long-term growth and profit margins and all that kind of stuff. I think a good test, kind of once you get to the end of that, is just to ask yourself questions like, would I be comfortable? And this percentage will vary for each person, but let's say like the maximum you ever put into a particular stock kind of at cost is maybe 20% of your portfolio or whatever that is for you. If you ask yourself the question, would I be comfortable putting 50% of my family's net worth into this particular business, and would I be confident that it's going to work out over the long term? I think that's a pretty good, just like mental test for, is this a great business at a reasonable price as well?
That's intense. Throw down the whole portfolio on it. Would you do it?
Yeah, not saying that you should, but I think
yeah.
you should be getting to that level of comfort.
Those opportunities are few and far in between. So
yeah,
it's a good test. It's a mental test more than anything else.
Yeah. Maybe you modify that for this discussion to say, would I be comfortable putting, that whatever the percentage is into this company at the right price?
Like but a large percentage of the portfolio, that's kind of your vibe check. Like, does this pass the vibe check? If this were to suddenly become a massive portion of the portfolio, would you be comfortable? I think that's probably a good way to think about it. Just kind of like for the feeling side of things, when you're trying to figure out if something's really a good business, that would be a good way to test it yourself.
Mm-hmm.
Even something I've noticed with Tom Wood.
I was just going to say, is this where we play that Elon Musk song? Is that called like It's a Vibe or something? Remember when he came out with a track?
Yeah.
I don't remember that one. I've missed so.
Don't
look
doubt your vibe.
Terrific.
Don't doubt your vibe.
Oh, that's gold.
Yeah. Even with these tech companies, like, the dual class or even more than two classes of shares that they have, I don't know. It doesn't really make sense to me. It kind of, I get it. They're a great company. They're growing at a great rate, but all the shareholders are not at the same level, which seems like a misalignment of interests. What do you guys think about that?
That like the one that comes to mind is like Google Class A and B shares.
For me, the thing that came to mind was, again, Palantir, because they have like 3 different classes of shares, and the founders can basically control all decision making in the company, irrespective of their percentage holding. So they can even sell off shares, but still increase their voting control. Doesn't really make sense.
Well, but they'd still be diluting. So like they're still financially incentivized. They just don't lose control. So it does remove a little bit, but in the grand scheme of things, it doesn't seem like you do that much. If as their goal still is to maximize value for shareholders, even if those shareholders don't have control, like they're obviously buying for financial value, otherwise they wouldn't buy the stock in the first place. So like it's still aligned there.
It does, it kind of depends on the business and the management in particular. Like if you trust that management, then I don't really mind. Like I want to see insider ownership high. So if someone like Brett Kelly, which is my large position in Kelly Partners, he owns over 50% of the shares. So it's in his control anyway, and I'm fine with that. So as a retail investor, we're not going to make an impact of owning 0.0001% of shares or whatever it is we own. But it just depends whether you trust that management or not. If they have a lot of power, then that matters, I guess.
Because like the threat, if you think of like the closest like comparable I can think of is like an entrenched politician who has like no threat of being booted out. Like they might go reckless and do whatever they want to do, but it's not really like that with a company, because if you can only do that for so long before the company goes under or or if they're really doing something that's totally misaligned. Not to mention certain laws can force you to get sued if you're not upholding your fiduciary duty to shareholders. So I'm just trying to think of how much, like a worst case scenario where you really do have like rogue management that is abusing the fact that they have like all the founder shares, for example, and no one else has any actual voting share. Like they're still incentivized to do a decent job over the long term. And if they don't, they're in big trouble one way or another, whether it be legally through not being a fiduciary or financially by destroying the company. So
I think one of the main issues that can come in, and I'm struggling to think of an example, but one of the main issues would be around like executive compensation. If management started paying themselves huge bonuses and stock options and all sorts of stuff that you had no control over because of different voting rights, then that's not something you want to see.
Well, that would still, assuming it's actually disclosed, like it's going to come back to the bottom line one way or another, and that's going to affect the financial value of the shares if the executives are just siphoning all this money out of the company. Even if whether people can vote or not, like it's still going to harm them long term. Short term, they'll enjoy themselves, but long term as a company.
Yeah.
Unless you're
Kind of makes me think of NASPers in a way. Like what they've been doing is basically the compensation to management has been quite insane. And the future growth, yes, we think it could happen. It could be great, but the cost of actually compensating management is a present cost. Like we're paying present cost based on future expectations, which I don't know. It seems difficult for me to justify.
Well, that affects the price of the stock and affects the value today. So it's not like it's just going unchecked. Like it's checked in the value of the shares, or at least maybe that's a little too efficient market hypothesis for us. But
you haven't been following the meme stocks, Jack.
Yeah, true.
Nothing makes sense over there.
Yeah, like the thing is, like even with the meme stock episodes, like you can still make an argument that like this does make sense in the short term. Like it doesn't make sense like on the fundamental company basis, but it makes sense in that you have the short squeeze potential and that like there's demand there. I don't think anyone's arguing that that's sustainable. So like from a long-term hold perspective, it doesn't make any sense. But in the short term, it could definitely make sense. It depends on what you're doing.
How does it make sense in the short term?
In that, like you could, I'm not saying it's like
to the moon.
strong. I'm not saying it's strong. Don't get me wrong. But like you could make an argument that like we can drive a short squeeze and cause what happened with like a GameStop or with an AMC in the short term. And some people will get out great. A lot of people won't actually know what they're getting into. But for the few that do, like you could rationalize it in some way. That's what I'm saying. Even if that rationale is like really thin and not actually that strong, you could still make the argument. It's not like it's completely out of nowhere. That's really what I'm getting at.
So basically, good capital allocation is what leads to a good investment. Then that's that in a moat. That's what we're looking for.
Definitely for the long term. I was kind of getting more into the short term kind of philosophy that some folks have, and that's what causes a lot of the short term craziness. That doesn't make sense with the long term. But Frank, you posted that really interesting chart on Twitter recently showing kind of like how multiple expansion and like sentiment drive returns or in the short to medium term for like over a few years. But as you kick the horizon out over many decades, it really ties back to business fundamentals and actual earnings as opposed to just multiple expansion. And what was the other factor?
So earnings growth and dividend growth over time. So roughly it worked out, it had a time period to say, where do your returns come from in an investment? These are going to be rough numbers off the top of my head, but after 5 years, about 50% or slightly more comes from multiple expansion still. When you go out to 10 years, that multiple expansion is only 20% or so, and the rest, the 80% coming from earnings growth and dividend. When you get out to about 40 years is when all of your returns is coming from the business fundamentals, being the earnings growth and dividend growth. So it's kind of the benefit of having a very long-term time horizon, which actually surprised me. I thought even 5 years out, you would see more of the return coming from, I would have thought maybe 80 to 90% coming from earnings growth. But yeah, as you can see there, Jack just pulled up, 56% comes from multiple change after 5 years, 28% after 20 years. And after 40 years, it's all earnings and dividends.
It's
Not many
all of
businesses
that.
last 40 years. So
Yeah, I was thinking the same thing
It's
when
a
I first
big-
saw the chart. It's like, how many really make it that far? But it really
Hopefully
goes
all
to
the ones
that.
we're talking about today.
Yeah, exactly. The great businesses. It goes to that thesis of the short-term weighing machine, long-term, or what is it? Short-term voting machine, long-term
short-term
weighing
voting,
machine.
short-term voting and long-term weighing. Yeah.
Yeah. It really goes to that. I like the 105 years that they just threw in there.
That was the longest they could backtest
Yeah.
the data. Yeah.
I wonder what companies those are.
What is it, like IBM, Johnson & Johnson, General Electric? Those are all 100 plus, right? Yeah, cool.
Probably probably some oil company somewhere or something like that. But yeah,
Berkshire
couple
Hathaway
of-
in the future.
Few
yeah,
banks and things like that.
yeah, true.
All right, Jack or Karan, you got a business for us? We need a pitch.
Yeah, sure. So the company that I have always like kind of looked at but never actually bought into is Prologis. So it's an industrial REIT. I think globally it's the largest industrial REIT around. I'm not sure. Jack, you might know a bit about that too.
Other than that, it's just a gigantic industrial REIT. That's kind of as far as it goes for me, and it's
100
expensive.
billion plus.
When you just do some very back of the napkin math, it seems very expensive. But I haven't done too much research.
100 billion
So-
market cap. Jeez.
Yeah, for an industrial REIT, that is massive. I think it's like more than double its closest competitor.
Yeah, it's
So-
huge. It's huge.
Yeah. With warehouses, with industrial properties, one thing I've noticed, like from my own business experience, is that if you have the right sort of industrial property in the right location, which is basically close to urban centers and able to get onto like main highways and everything, like that warehouse, that entire plot of warehouse, it will probably continue to generate like decent cash flows for a very long time without any problems. And relatively they tend to be sticky, like in terms of the cash that you can get from the business, from the warehouses, tends to be quite stable. And Prologis has absolutely been killing it for like I think they started in like the 80s or so, and they've kind of grown through acquisitions and mergers. And the founder, who is this Iranian American guy, his name is Hamid Bogadan. He's been growing the company through acquisitions, through all stock acquisitions and also all cash. And recently they had like a $14 billion merger with Liberty Industrial Properties. And like they're very good at their capital allocation decisions, and they've been growing the business, I think, in a very sustainable way. So
What kind of
it's always been
prices
good.
do they trade at? Like, what kind of multiples or something? I know with REITs it's hard to use multiples, but what kind of valuation is that?
So say, I would look at it from a FFO basis, so rather than just earnings. But like, suppose you look at something like Monmouth. Monmouth is, I think, at 20 times price to FFO, and I think just off the top is like Prologis is like at 50 or 60, or
Right.
something quite higher, like way higher than that. So it's always traded at a huge premium because I think the market realizes the potential in the business in terms of the land bank that they own, the customers that they have, the way they've been able to kind of grow the business. Like, I think the market does pay a premium for Prologis.
And what kind of dividend yield does it pay out? Do you know off the top of your head?
That's a good question.
I think they pay out about 75% as a payout ratio. Do you mean, or as a final dividend?
The
yield?
actual dividend
I
yield.
think it's like 2 or 3% around that
Okay.
much.
That's lower
Yeah,
than I would have
I'm
expected
seeing-
for a REIT.
I'm saying 1.8.
Yeah, I'm seeing the same, Tom. 1.89, so it's about 2%, we'll say.
But something that's really interesting about Prologis specifically is that they've started putting like solar panels on top of all the industrial properties. And again, I work in the solar space, and the average payback period of an entire solar project on a warehouse, at least from what I've seen here in the UAE, is around anywhere between 3 to 5 years. So what I'm seeing is that as the solar projects continue to, pay back that money that they've invested right now, at some point, Prologis is going to have like a bit of a energy business within the REIT, if that makes sense. Because irrespective if they have tenants or not, the solar panels are still going to be generating electricity, right? So that lowers the costs in the long run. And if there's no tenant, it still generates a lot of cash flow. So
do those solar panels generate income now? Because like with a lot of industrial leases, usually the expenses are all given to the tenant anyways. So is this like just to use the space in a more productive way, or is this like an amenity to the tenant?
no, it's to lower the overall cost of electricity, right? So
Well, yeah, but what I'm saying is that Prologis probably doesn't pay the electricity in the first place. The tenant probably does. That's at least how a lot of industrial leases work.
yeah, but in the period where suppose they don't have a tenant, right? They have to still cover the costs of maintenance of.
Well,
So on and so
yeah,
forth.
but I mean, right now, industrial has like no vacancy, anyways. So they're probably fine there.
Yeah.
I'm just trying to think like that. That seems like a very expensive thing to go for if you're just trying to lower expenses. But if you're trying to produce income, like you're getting at,
They
like,
could sell it back to the grid, surely.
yeah, that's what I'm getting at. Like, are they doing that to produce cash flow or to try and like offer an amenity to the tenant? Like, hey, your electricity expenses are that much lower. Because I'm assuming
can also
Prologis doesn't
charge-
actually pay them.
They could
it
charge
follows
higher
more-
rents because of the benefit of having the
Exactly.
cheaper
Yeah.
electricity. Yeah.
Is
Yeah.
it that much though? I wonder. But sure.
So it's a
So
bit
yeah,
of a
then
scale
that would be like the
economy
amenity
share.
argument. So yeah.
Yeah, so it's a bit of a scale economy shared model thing that I'm seeing here. And what they're doing is basically right now cash is easily available. They can raise debt and they're investing that into putting these solar panels across their properties. And in the future, most likely electricity is going to be a lot more expensive because you need electricity to power electric cars and so on and so forth. Everything in the future is going to need electricity. And it's kind of like a bit of an inflation hedge also put in there. That's how I see it.
Do you have any idea of what kind of clients they have leasing their properties?
I think the largest client is Amazon. So Amazon is
I
like
was thinking that might be the
6% of.
case. Yeah.
Yeah, Amazon is like 6% of their total client base. And apart from that, they've also got like a services based revenue source. So they're slowly diversifying and they have other partnerships also in place. So across the world, they've got quite a few partnerships in place. Yeah.
Well, yeah, if Amazon's their largest client and it's only 6%, then they're very diversified with revenues, which is probably a good thing for any REIT, I would say.
At that size, you'd have to be diversified.
You have to be,
It's such a humongous REIT. Like you can only have so many tenants that fill up that much space. So it makes sense that even a huge company like Amazon would only make up 6%, which is still a lot on that big of a portfolio.
Until C Limited keeps growing at 100% and takes over all the warehouses.
Exactly. And buys Amazon while they're at it. Karan, you mentioned Monmouth, and that was actually the company I was going to talk about. Since that Monmouth Real Estate was the company that Equity Commonwealth was set to merge with. And I was looking at my old notes. So here's like I made like a little presentation for the channel a while back. And like this was, depending on how you valued the portfolio, industrial real estate in general is just super expensive. So like the way you value real estate is you take the income, the net operating income as it's called, and then you divide it by a cap rate. And that's kind of like your unlevered return, if you want to look at it that way. If you didn't have any debt on it, this is what the properties would throw off. And then that's how you get your property price or property value. The deal was something like $3.5 billion, which means that they were buying the properties at something like a 4 cap rate. And that's it. It's 4% on industrial REITs. And like the more I was thinking about this deal, now that it's like fallen apart, I'm like, do I really feel bad about them missing out on this deal as an Equity Commonwealth shareholder? Even though Monmouth strikes me as a very, very strong REIT. They have a lot of great properties. They're speaking of tenant diversity, they're not very diverse though. It's like over half was FedEx warehouses, but otherwise it's 99% occupied. All their rents are being paid. They've been building up a really solid portfolio, or working towards some more diversity to kind of solidify their cash flows. And they've built a really, really strong real estate portfolio. But then Equity Commonwealth comes in to try and merge with it at what's approaching nosebleed prices for industrial REITs. And I was thinking, like, is this really a bad thing that they walked away from it? So I think Monmouth might, at least in my view, just industrial real estate in general, if you're buying like totally leased up, super low risk, it doesn't really seem worth your time, at least in my view, given that the returns just aren't going to be that high, because you can only bump rents so high, especially when you're working with something like FedEx. Like, they're going to have a lot of leverage, so you can't bump their rents up super high, or much higher than they already are. So kind of sticking with that theme, Prologis, just the industrial warehousing space in general, it's very expensive right now. And you might be able to find some opportunities, but everyone is looking for them in warehousing and industrial right now. So that's what I'll say about that.
What's kind of a high, low, and average cap rate? I have no idea with an industrial.
Right now, this is about market cap rates for like Class A industrial, which is, it's like getting below 4%, which is crazy. Because think about it, if you were to buy a building with all cash, you'd be expecting something like a 3 to 4% return, essentially, which is nothing to take on the risk of owning a property, all the capital expenditures that come with it. And people are glad, large institutions are gladly paying up for that now. Sam Zell was about to pay for that right now. And he's this prolific sort of value investor within real estate sort of thing. And even he was about to pull the trigger on this deal until Monmouth said, no, we actually want to go for someone who will pay even more for this property potentially. So these are about as low as cap rates get in the entire real estate industry. It's in manufacturing, or not manufacturing, in warehousing and that sort of side of industrial space. Anything below 4 is, I don't really think, has ever been seen before, but that's just because interest rates have gotten so low. So people are just starved for yield. And when you can see this, low risk, safe yield in industrial that a lot of people are seeing, it drives cap rates down to these super low levels. So yeah. But if you go to something like retail or office, you're going to be much closer to like 7 or 8%, even up towards 10%. It all depends on the area and the class of tenant, but broadly speaking, it's going to be much higher than industrial right now.
Just to play devil's avocado a little bit on this, do you think that so presumably some sort of spread in cap rate is justified between like office versus warehousing, because presumably the growth prospects for warehousing look a lot better than for office.
Yeah.
I mean, do you think that, because I guess those cap rates are kind of like a year one return, right? Assuming that you're going to grow rent out into the future. Do you think presumably there's a lot more capacity to push rents higher faster than you would being able to buy other types of real estate?
Probably not, at least with that tenant base, because like I was saying, like a FedEx client would have a lot more leverage than some random, mom and pop warehouse company, if those even exist anymore. And like Karan was mentioning earlier, with a lot of industrial leases, you're signing like, a 30 to 50 year lease, and you can only raise rents every 10 years anyways at some fixed percentage. Usually, depending on how much leverage the tenant has. So you can negotiate these terms, obviously, but you're not going to be able to just like year 2 or 3, most likely just shoot rents up right away. And even if you did have that option to raise rents, it comes back to the market. And it would be tough to push rents that much higher, that much more quickly, especially with large companies that have a lot of leverage.
Jack, I actually disagree with you there, because so at least with Prologis, like a lot of the warehouses are built to suit. So the company, for example, Amazon, has a lot more to lose than Prologis by giving up that location. So in fact, Prologis can raise the rents. And that's kind of what drives industrial properties, because it's like other REITs, you may say, yes, interest rates have a greater impact than anything else. But with industrial REITs, the economic growth in that GDP has a huge impact, even I'd say more than interest rates. So here, the operators, say Prologis or Monmouth, they have more leverage to raise the rents at a quicker pace than, say, an office building or something else.
I think you're getting at is like location, essentially. If you have a really solid location, you can't recreate it necessarily. So you have leverage
Location and
there.
also the kind of tenant, like why has the warehouse been built the way that it's been built? So, for example, like in the UAE.
What kind of build outs are we talking about here? Because like it's a warehouse, there's only so much you have to put into it, I would think, unless you're getting into real complicated things.
Yeah, at least, so what I've seen here, I mean, I've seen from the outside, but in the UAE, so Prologis has this warehouse space with this logistics company called RMX. And the way they've built it, like the location, I don't see RMX moving out of there for a very, very, very long time, probably as long as the company's around. So for them to kind of give up this space seems unlikely. And Prologis can maybe raise rent significantly, in the future, if they want to. Yeah.
Well, that's also actually this is sort of
It's
a side
not just
point,
a box. That's what I'm trying to say. Like, it's not just a box. There's more.
Yeah, it's like yes and no. In that there's a lot of, or at least people are trying to build as much industrial space as possible right now because of this demand. Because like look at the cap rates you can get just by building a box, essentially. Yeah. So like. But that takes years to make to move the needle a lot. Just building new real estate supply, especially on a large commercial scale. So with these sorts of cap rates, I really would not expect them to stay this low forever. It just whether that be through new supply coming on board or just rents getting to, or even just rents being raised at some point, at least a little bit. It's just these cap rates are so low. You really got to factor in some significant growth. And sure, you can make the argument that like certain locations you could bump rents because they're built out in a special way or they're in just a super primo location. But when we're already talking about class A industrial, there's only so much more you can squeeze out. It's not as though you're going from like C to A, then you get some huge rent growth, some huge property value growth. I guess you could say it's kind of like a super large business. It's hard to grow from 100 billion to a trillion, whereas you could, I don't want to say it's easy, but you can usually get those much more often get those outsized returns from like 10 million up to 100 million or something like that. I don't want to say it's easy, but it seems like it's a lot easier to do that than take 100 billion to a trillion or something like that. Because it's just, it's very hard to manage a company that large or that successful, I suppose.
So you're telling me C Limited can't keep growing at 100%?
Exactly. There's some compression there. There has to be. But people never seem to want to factor that in when you get to these big companies.
Yeah, you need to go look at that rice on the chessboard thing when it doubles every square. Eventually, you've taken over the universe, right? So
we were talking off air the other day about some people who weren't particularly familiar with finance, and they were talking about how I expect like Bitcoin to grow at like 45% per year, like 80% per year for the next 10 years. And it was just like, do you understand how massive that like the market cap of Bitcoin to be at that point?
Yeah.
I think we got into the quadrillions or something. It was just like mind-boggling numbers that we couldn't even figure out.
Yeah. What was the other one? It was like, so Warren Buffett's the greatest investor ever. Guess what his annual return was? And they guess like 80% or something, right? I think that's what it was. Yeah.
That was one of my mates. Yeah. He said 100% for the next 10 years for Bitcoin. And he thought Buffett had compounded his money at 80% for the last 60 years.
Yeah.
And here he is cruising at 15 and we're like worshiping him.
There you go.
It's just,
Jack, can I just ask you one more question on real estate before we maybe jump into questions? With the you'll be way more familiar with this in the States than probably I am. But I know in New Zealand, we've got a lot of, even if tenants do sign like long-term leases at a property, say a 10-year lease or 5-year lease or something. I know oftentimes there's like inflation is built into how much they can push rent. So maybe it'll be like inflation plus 3% or something, to that effect. So how does that affect how you look at these cap rates? Because inflation the last 12 months has run like 5 or 6% in the US, right? So presumably really you can push rents more.
That is a term that you can definitely put into leases. in my like commercial real estate attorney experience from the leases I've seen, which has mostly been with like kind of Class A national type tenants. I haven't really seen many inflation terms built in. Usually it's something like, all right, at the end of 5 years or 10 years, we'll be able to raise rents by some fixed percentage. Not necessarily tied to CPI or something like that. Though you could definitely put that term in there if you want. I just haven't seen it too much, but that's kind of an anecdotal connection. You definitely could put that in though. Often you'll see that for like variable rate mortgages, they'll be tied to some sort of rate, whether it be like LIBOR or the Fed funds rate or something like that. You'll see that a lot more often. With rent, it can be tied to whatever, or it might even just be fixed. Like it's not even it could just be a fixed percentage or something like that. And then you might have like options to extend after that, like mutual options, or one side gets the option to extend, and then you can make the call there. So there's lots of different ways to package that risk is what I'm getting at.
Yeah, interesting, because I haven't looked a lot at commercial real estate in New Zealand, but as I understand it, that's a very common thing to have in some of these agreements.
Usually there's something, and usually it's going to be
because you're pretty
like
exposed otherwise if something crazy does happen with inflation as a landlord.
Yep. But well, yes and no. Yeah, because you're also paying back your loan in cheaper dollars unless it's like totally variable. But usually it's a fix for like 5 years or something before your interest rate would get jacked up in that case. So you still have some protection there, and theoretically the value or the price of the real estate would be going up too before those interest rates are jacked up. So. Yeah, but you're right. You would be exposed if you don't have the ability to raise rents pretty quickly. You might find some opportunity to break the lease at that point if you could, or pay some sort of breakup fee, or if that happens to be an option. It all comes back to leverage between the parties. Yep. Let's dive into questions. Yeah,
I've got a quiet chat today.
We still got some good stuff. But
people are just sad that Brad's not here.
Yeah, Brad's in Turkey, and
without Jackson, like the chat's quiet. It's quiet. So.
Yeah, damn Jackson.
Let's see here. Here's one from Clayton. This was earlier, almost right before we started, actually. Often value investing encompasses buying equities at below intrinsic value and waiting for a mean reversion. Any thoughts on buying put options or leaps against stocks where exuberance has taken over? So using options when you think something's overvalued. I don't think he's getting at selling put options because that's something you definitely could do.
That in the long run that the earnings will normalize and the stock price will fall.
Yeah,
it's a bet essentially.
It's almost akin to short selling, and I guess with options you can get more than just a double, whereas with short selling, you're fixed to the actual price of the stock. So I guess there's something to be said there. But you have the time decay of the options to worry about, and like that's a whole different ball game. So the only thing I would really consider doing with options for kind of a longer term sort of thing would be like what we've seen a lot of value investors do, which is sell put options at some price below whatever your target price is, basically. So that way, if the stock does come down to that target price, you're then forced to exercise, but you're buying it at a price you're happy with, theoretically. And that could be a good way to generate some income while you're waiting for that opportunity, depending on how conservative you are with holding your cash pile. That I think is one of the more savvy ways to use options as like a value investor. But you could get a lot more aggressive with leaps and other types of options too, depending on what you're going for. Any of you guys use options or consider using them?
I've never used them, and I don't think I ever will. I try to keep it as simple as I can. Just long only, no options, no shorts. I think if you were maybe a fund manager and it was your full-time job to think about these things, maybe you could incorporate some type of options and shorts and hedges and everything else. But I think for the typical retail investor, you're best off just focusing all your time on finding high-quality businesses at cheap prices and let it go.
What about covered calls? Covered calls, like where you own the stock and then you sell a call at maybe a target sell price that, like if the stock got up to this value, I'm definitely selling it. Would you consider doing that?
I personally wouldn't. I could see why you would, as long as you don't have to spend a lot of time kind of considering this. And
I don't think you would.
Yeah, you wouldn't in that case, but it's just not something I personally would do.
Yeah. Fair enough.
Yeah, the only thing I might add to this, and I'm going to preface this by saying I've never bought or sold an option in my life, but this is, which is sort of two things. It's partly an access thing just from where I am in the world, and it's partly a tax thing, which I don't really want to get into in this. But the option strategies that have made sense to me that I've seen other people do is selling puts, like I think you said, Jack, where it's basically like you're going to buy a stock at a particular price anyway, so why not sell puts and generate some income from, doing what you intended to do anyway. I guess the risk to that is it never gets to that price, and maybe it runs up and you don't get the chance to buy it when you maybe should have. But I think that makes sense. And then I think leaps can make sense in certain situations, like
super high conviction.
Binary situation.
Yeah, binary situation. So this is sort of a Toby Carlisle view where I'm struggling to think of an example. Maybe even something like Seritage might be an example where if you're right, the returns can be pretty good. If you're wrong, it's probably a zero.
But it's not going sideways.
Which is kind of which is the exact same outcome you can have with a leap. So why not get the same exposure with a smaller percentage of your portfolio rather than just buying the stock straight up? I think that can make sense, but like I say, I've never actually done it. This is all just theoretical. So
I think the bigger risk with the selling puts is that you have to tie up cash in the meantime, and you might want to use it towards something else potentially, and then you got to close the put, and then you could be down, because the whole idea is that if you don't exercise, you want it to expire worthless, and then you keep all the premium. But if you want to use that cash, it's tied up. So that's like the opportunity cost, is that you need to have cash ready to go, and that'll be tied to that option until it expires or it's exercised. So
the one other concern I have with it is it kind of forces you to think more short term within your research. Like,
definitely, yeah.
What's the price going to be in the next 6 months, 2 years, whatever it is? Whereas I'd try to have as much of a long-term mindset as I can. And I think if I started looking into options and everything else, I think it just takes you down the wrong path, potentially. Not to say that it can't work. It's just not something I'll do.
Yeah, I think it's you definitely have to make it like a cream on top kind of thing. Like you've got your core philosophy, and then maybe you do some fancier stuff to lower your cost basis or
just become
whatever.
Michael Burry.
Well, yeah, I think if anyone's really interested in this type of stuff, like I don't know if you guys are familiar with Matt Peterson at all, Peterson Capital Management. So he's the one that has done some deep dives on Seritage actually, but I first came across him from his work on the Daily Journal Corporation, and he's very much a long-term like buy and hold investor, but he uses options kind of around the edges to get in and out of positions and reduce cost basis. And he's got some good research on like how much it can add to compounded returns over time.
Yeah, that presentation, I forget what it was from, the most recent investor presentation I think he did. That was the best case I've seen made for that. But yeah, again, not for me.
It's on his YouTube channel.
Yeah, he's got a podcast with Toby Carlisle from like a year ago, or maybe more than that, going into it as well with some examples.
Let's get another question here. That was a good one. Stefan mentions thoughts on Adobe as a super high quality, potentially overvalued. I think you could probably say this about a lot of kind of the software as a service stocks, and that they're very hot right now for many of the reasons like Tom led off with, in that like they're pretty predictable. You'd think they're capital light compared to many other businesses, and it's a lot easier to scale that. So people are paying pretty exorbitant multiples sometimes.
Do you guys use the Adobe products for your YouTube channels?
I did, but I no longer do. Though I guess
so
my editor does now. So yeah.
Yeah, like that's an interesting case study. So I use Adobe Audition for my podcast, and I forget exactly what it costs, but it seems like crazy expensive to me
It
for
is.
like an audio editing software. Like they've clearly got some sort of pricing power to be able to push it to that level, but it feels like it's getting stretched. And unless I'm like some professional editor, which I'm not, I really like if there was some alternative that popped up tomorrow, I would probably cancel Adobe and go to something else.
DaVinci Resolve. It's there for you for
Yeah.
free. It's fantastic. Any video
Well, there you go.
editors out there?
You've just saved me like I think I pay like $40 a month New Zealand or something.
Yeah, that's the reason I didn't do. I used like Adobe Premiere Elements 12 that before they switched to the software as a service like monthly model. It's like a CD I got in high school. So like I used that for a while in my first like year on YouTube before I switched to DaVinci, which was a lot more powerful once I upgraded my computer. Because it is very expensive. But one thing they do pitch on their site when you can get a discount by buying a share of Adobe stock. So I wonder how
Really?
much that. Yeah. I was about to pull up their homepage to see stock. Let's see, discount.
It is a very high quality company, though. Just looking at those typical things like returns and margins and growth and everything else, it's been a hell of a compounder. I know. I'm blanking on his name now. Chuck Acro is a recent shareholder, or his fund is a recent shareholder, and he's always talked about that business as being one of the high quality businesses in the world, with great management team, great capital allocators, high margins, reinvesting a lot of their cash flows back in the business. He talks about their moat, which he, off the top of my head, I don't really remember, but he was talking about the larger organizations that are kind of locked into these contracts and wouldn't bother changing, which somewhat makes sense. Maybe for the individual users like us on the smaller things, we could switch pretty easy. But I think, so I work in teaching, and I know the Department of Education have Adobe contracts for every staff member in Australia, and that would never change.
Yeah.
I think that's where their moat kind of comes in.
Here's their pricing page. As you can see, Adobe stock, you can get like a free trial with it, which I think is hilarious. Pump the stock. But yeah, like you're saying, Frank, you got the business tab over here where you can buy everything for $80 a month. Students and teachers, so they have like education focus. And look, that's 3 of the 4 tabs is like non-individuals. So I do kind of wonder what the full breakdown is.
I think Zoom have started ramping their prices as well. Actually, I don't know if you guys have noticed that.
I have not, because I'm not using Zoom as much. I use like a different one for work.
Yeah.
Like how significant are we talking about?
I'm blanking. This is for work stuff because we need one of the premium packages for that. It
but
might
like
be
a
like
double.
30, it might be like 30%.
That's a big jump if you do that across the whole ordeal.
Yeah.
It's a good time to do it while everyone needs it.
Right.
Yeah, I mean, it's the beauty of software businesses. You just have to have a sticky product is kind of the catch.
You just slide it up and down. That's it. You change some code and then you're done.
After dinner investors popped into the chat.
Oh, there he is. There he is.
Good old Jonathan.
Yeah, coming in at just the tail end here. Let's get a couple more questions before we wrap up. This kind of goes to our conversation towards the beginning of the show. Do you guys get worried about companies that use marketing to generate a lot of revenue, which many of these software companies do?
Yeah, I wrote down a couple of company names when this question popped up originally, actually. We've kind of got at it a few times here, and I think we probably just did again. It really depends like how sticky the product is. I mean, if it was, so I wrote down a couple of companies. I think with subscription style software businesses where it's like there's a bit of what Phil Town would call a switching mode, like it's just a pain in the backside to go to another similar product, like to pull your business from accounting software to some other, accounting software. I think if you're spending marketing money to grow those types of businesses, I think it can make a lot of sense. If you're using marketing to sell something that you just purchase as a one-off, I actually wrote down wish.com here. I think if you're purchasing some gimmicky product that you're going to pay for once, and that's kind of all that wish.com are going to get out of those marketing dollars, I think that can lead you to some dangerous spots. But what do you guys think about this?
Yeah, I think I've spent like $10 in my life on Wish through like maybe
Yeah.
two purchases. Like, so yeah,
Yeah,
that's a
I
good.
love
That's
the
a
Wish
good point.
memes as well.
They are top notch.
I
Unlike
actually
the product.
think usually it's a good thing, assuming that it's recurring revenues with a high retention rate on those customers, which a lot of these SaaS businesses, like you said, Tom, are that, and that's where we see a lot of the high expenses in marketing. And you could almost put that down as a growth capital expenditure in a way. But yeah, I think
Like
in an
churn?
early stage, almost, yeah, in an early stage company, if it's a high retention rate on those customers and they're going to be recurring revenues for a long time and they're sticky, it's a good thing. So when someone like a C Limited is doing that, or even like a Xero, like you were talking about, Tom, probably a great thing that they're spending a lot of marketing early on just to build that brand recognition and get the original customers in the door. And then you can drop that back off or stabilize it at least over time.
Yeah. Like
Yeah,
imagine, sorry, I was just going to say, like, imagine if Apple didn't spend billions of dollars on marketing in the early days to pull you into the ecosystem, how much revenue they would have lost out on. And like, I'm fully in that ecosystem now. Like Apple, I could never see Apple advertising anywhere ever again. They could spend zero marketing on me and I'm not switching away. So in those types of businesses, it does work. Sorry, Karan.
Yeah, even Coca-Cola, same thing. Like they spent a lot of money upfront on brand and marketing, but that's paid off, I think, in a huge way. I mean, it'll be hard to find anyone who disagrees with that. So,
It still do spend quite a bit on marketing, at least in the US.
but it's a percentage of revenues compared to like
Yeah,
what they were
I
spending
think you're
in the
right.
80s, 90s.
Yeah, yeah.
After Dinner Investor just asks, did Frank jump into Tencent Process or Naspers yet? So he's just exposed himself for not watching my channel. If he wants to find out the answer,
hit
he can
that
head on
notification bell.
At least
I think three of us are long
answer his
process,
question.
over. Well, the answer is I own Tencent and Process, kind of split into one position. I don't own Naspers though. Tencent's about a 5% position. Process is about a 5% position. But I'm still just thinking of it as a 10-cent investment pretty much.
I think three of us are in process, right? I think Jack and Tom, you're not in it?
Yeah, I'm not.
No?
No.
I invested in my sewer fix. That is all fixed now. that
Did the insurance company cover it? Or?
We're working on that now. I haven't even had an adjuster out here yet, so I've already got it like all fixed. So I've like recorded everything because we had the hurricane hit in the deep south here in the U.S. So like insurance companies have been like off the rails right now working on that stuff rather than my lowly little thing here in Chicago. So so we'll get to it soon, and I'll have an answer and some content coming soon about that. Let's get like one more question maybe. Oh, here's one. A decent hypothetical. Would you have held on to Microsoft if you bought in 2000 and then sat on 0% returns or even negative returns for 17 years while you waited for it to grow? Because the company was growing during that time.
Yeah, absolutely. I was 6 years old and I would have no idea what a stock is and I'd be holding on to it. Yeah.
Wonderful.
Yeah.
This is one we've definitely talked about it before, where like this is where the initial buy price makes such a huge difference. Like Microsoft was always a great business, or maybe not always, but like by this point, by 2000, definitely a great business. It was clear it was. And it continued to grow its cash flows throughout this whole time. But because of the tech bubble, valuations got so out of control, it took a while for them to come back down to reality. And then it kind of corrected itself into more of a general upwards growth trend. But it took a long time to actually get back down to reality. So I guess you could say like it depends on you making the mistake of buying at nosebleed prices in the first place. Then do you hold? I don't know. That's a tax question at that point.
The interesting thing with Microsoft, I'd have to do the numbers, but I think it's done so well obviously it was flat for 10 years in the first decade of 2000s. It's done so well in the second decade of 2000s. I think you still would have beat the market, even though you were flat for 17 years.
Yeah,
I think
probably.
I'm right on that. I'd have to double check.
Yeah, that sounds about right. Here, I'll check for you.
Yeah,
And
it's
that one's hard to answer in hindsight anyway.
It
I
is.
don't know the numbers, but assuming that the intrinsic value of the business was growing consistently for those 10 years or whatever that was flat, I'd like to say I'd hold on, but it is such a long time that
Yeah.
you would think it would be an opportunity cost after 4 or 5 years if you've seen it going nowhere.
Yeah, I feel like you'd see some other investment and be like, I'll move my money from here into that one or something like that. Not even like I hate Microsoft sort of thing, but just like I'll just go for something else in the meantime.
I don't know how impressive the numbers were, but if you could see that there was underlying free cash flow growth of high 20% that whole time, I don't know if that's true, then maybe you would hold on in that situation. But I just don't know what the business was performing like during that time period.
Oh yeah, Tom, it's not even close. Oh, whoopsie. Let me there we go. So here's Microsoft. We'll just approximate January 2000. We're at like 1,000% growth versus
just go through to 2016 though, Jack. That was flat for that part, and it's crazy. What's that done?
10 bagger in 20 years, no part.
Versus about a 200% on SPY. Back to 2016. We'll just go to end of 2016. That's like a 50% ish return. Granted,
plus dividends, I suppose.
Yeah, plus dividends. So but still, it's not going to make that much of that humongous of a difference. Versus, even to the end of 2016, they still would outperformed, which is kind of crazy.
How long were they flat for from that peak?
I think it was 2014-ish.
Yeah, if we go to, I think they peaked at
2015. I think
$25 a share.
We'll call it around there, and it took them
till 2015.
Well, they actually did hit it, and like before that, but
up and down, kind of,
yeah.
Still,
they really like substantially surpassed it. Looks like
2013 or so.
Yeah,
wild,
up and down. So yeah, I don't know if I was hitting the exact peak there because this is such a small graph. But anyways.
Yeah, it got to like a 600 billion market cap or something crazy, I think, in 2000.
They had such innovative products like the Zune, wasn't it?
Oh yeah, the Zoom. My brother had one of those and it like broke immediately. the Zune. But they just keep shelling out new things and acquiring new companies. They're really a hedge fund at this point. They're not even just like a straightforward tech company. They got so many different assets. I guess you could say that about Apple too. Their hedge fund is like one of the biggest in the world. Their internal like hedge fund they have. I forget what's the name of that one. I forget. But they have like an internal hedge fund that is like a subsidiary that is actually one of the largest in the world at this point, which is kind of nuts.
Everyone's becoming Tencent in this rate.
Yeah, right. Exactly. Got to put all that cash somewhere. How about one more?
Let's do it.
Let's do it. I can answer maybe just quickly that Eddie Lampert one about Seritage.
I saw it. Yeah, I saw that earlier.
Mastodon 91. So yeah, if you look on Dataroma, it looks like Eddie Lampert's been buying Seritage. I'm 98% sure that that's just him converting his operating partnership units rather than actually straight up buying new stock. So I wouldn't read into that.
Well said.
Heritage is like forget about it till like 2013 and then come back to it then. It'll either be there, it'll be a great business, or it'll be gone. So
how to pick one. You guys like one here? I'll default to you guys.
You guys want to do Movember with me?
Who asked that?
yeah,
that didn't get.
What's that?
Giveaway. We forgot about it.
Oh yeah. Should we do the giveaway next week?
People that have lasted this long.
Yeah, I'm afraid people might have dropped off. The brave souls that make it all the way to the end.
And they deserve.
Do they deserve
yeah, they
it?
deserve it.
They deserve it. Or should we
it.
do our giveaway next time?
I give him a shot.
You guys got a beg in the chat. Should we do our 2,000 subscriber giveaway? Yes or no? Okay, I guess we'll do it. So for this time around, we did a giveaway when we reached 1,000 subscribers. We gave away one of our mugs. We're gonna do should we give away a mug again? Is that the goal?
Yeah, the Punch Card Brew mug.
Punch Card Brew. Here, let me hold it up. Get one of these pint glasses. Punch Card Brew. Well, currently filled with some nice crisp water for myself.
Not what it's meant to be used for, Jack.
Yeah,
I can confirm the beer goes down well out of the Punch Card Brew glass.
it's pretty nice quality. The lettering, it's. I was actually like pleasantly surprised at how solid it was. So, anyways,
I'm still waiting for mine.
Karan, the creator, we got ours before him. Anyways, we're gonna give away one of those, but you have to do one thing in order to be entered into a semi-random drawing where we'll draw random names if you meet these criteria. You guys have to go down to the comments and leave us a value investing joke, and the winner will be displayed on our on next week's episode. You got to leave a comment though, not in the chat. So go down to the comments and leave a comment there on this episode. Your best value investing joke, or I guess best investing joke in general. Value investing might be a little too niche. Best investing joke. If there's one that we really, really like, we might just scrap the random drawing and pick that one. But if we're having trouble, we'll do a random drawing.
Jack,
So,
weren't you gonna give us like weekly finance jokes a while back? Didn't that?
I never
I feel like we
promised.
only did one round of that.
I never promised to do that. You guys just wanted me to. I definitely never agreed to that. I gave you my
Have
best
you got any
economist
for
joke.
us?
a while
You should have
back.
gotten it in writing, like.
Yeah.
Yeah, I don't really have any off the top of my head, and I don't want to.
Warren and Charlie walk into a bar. No, I don't know.
No,
I got nothing.
I don't want to. I don't want to. I'd be best to just pass on this one rather than try to fumble through one, and then that would be awkward. So we'll avoid it now. I'll try to think of one for next week, though. We should all think of one for next week because it'll be good with the theme. Once we get all these comments, for all the brave souls who make it to the end, I'll try to leave comments on the episode too for anyone who comes in late. I do want a good population of jokes here. So one more time, go leave a joke in the comments below, not in the chat, and we'll pick the best joke. Or if we're having trouble, we'll do a random drawing, and a winner will get a Punch Card Brew mug sent to them once you give us your address. We'll work that out after the fact. So stay tuned on next up. Go
Also,
for it.
yeah, they can buy one if they want to.
Yeah,
and all the
if you don't want to wait,
proceeds- Yeah.
if you don't want to
all
wait,
the proceeds,
go for it.
Yeah, all the proceeds from the mugs kind of get donated to Dakshina. So I don't keep any of the money. It all gets sent to Monish Pabrai's foundation. And
Nice.
I tend to wait till like $100, but we're at like around $55 in profit right now. So every time it hits 100, the money gets sent off. So
Massive compounding right there for a good cause, all within the value investing community. Guys, we're trying to get Monish Pabrai to pay attention to us, and maybe we'll get him on the show one day. That would be fantastic. If anyone has a plug, otherwise we'll definitely. I like that idea, Karan. So go support Karan's shop down there. It's got a lot of good punch card merch there. If you don't want to wait for this giveaway, there's other stuff on there, including the Shameless Cloners mug and others. So, and what was it, Spackman?
that's cancelled.
that one's
Obvious
canceled,
reasons.
just like the deal.
The SEC told me to take it down. Yeah. So.
That was a good one too. Anyways, were we gonna do one more question, or should we just wrap it up there?
I'll go all day if you guys want to
I'm
keep
out.
going. You're
It's
cool.
only midday. It's midday for me in time. We're sweet.
It's 11
I'm just
p.m.
getting
here.
started.
Yeah, Karan just woke up.
Karan's still waking up.
Yeah, I'm the limiting factor in how late we can go, and Karan's the limiting factor in how early we can go. So this is our window.
It's just 8 a.m. here. Like
You're warmed up. How about this one? Have you ever bought an over-the-counter stock? How was your experience with the illiquidity? Well, for me, Pershing Square Holdings, the hedge fund, speaking of Bill Ackman, that's an over-the-counter stock for me. And I mean, you pay an extra fee because it's over-the-counter, and then that's about it. So if you're making a substantial enough investment, like the fee is kind of negligible anyways. So So far, so good, but that's a relatively big hedge fund, though, so it's not as though it's like a tiny little weird one. You're probably going to have very, very different experiences depending on whatever it is. Just the fact that it's over the counter doesn't necessarily mean that it's super illiquid. Maybe it's more likely to be illiquid, but it's not like a guarantee that it'll be like impossible to get rid of or something like that.
It's always smart to use a limit order when buying an OTC stock because
Definitely, or just any stock really.
Yeah, I mean, suppose you're buying Apple, doesn't really matter.
Yeah,
It's
right.
a market order, a limit order, but with OTC, definitely, I mean, you can get screwed over in the price. Yeah,
I bought Tencent and Process over the counter from here in Australia. They're fairly liquid stocks, so just because it's an OT stock doesn't mean it's illiquid.
Right.
If you're buying some real small, obscure micro cap over the counter, then maybe you might have some issues depending on how much money you have. Again, though, I've bought into a few very illiquid micro caps, and I've never had a problem kind of buying in within a day or two tops. So unless you have a lot of money, you won't really have an issue unless you go super, super small. At least that's my experience.
I'm yet to have the privilege of moving the price too much with buying a stock.
That'll be the day when we start our SPAC. Or were we in the works on that, Tom? Getting our SPAC going for Punch Card.
Yeah, yeah, just working through a fair bit of paperwork around that. So just leave that with me.
Yeah.
I'll have Jack.
Go ahead.
I was just going to say I'll have my people get in touch with your people, and we'll make it happen.
I'm actually representing the SPAC as counsel, so like we can save a little bit of fees there, and then we'll pay the filing fees once we raise enough from some early friends and family investors, and then we'll take it
friends,
public.
family, and fools.
Yeah. Yeah. So stay tuned for our SPAC. All right, I think that's a good place to wrap up. Reminder to leave your best jokes in the comments below for a chance to win a Punch Card Brew mug, and that'll be displayed next week. And looking forward to reading those. That'll be fun. Otherwise, if you guys like this video, like it. As always, that helps the channel. And if you haven't subscribed already, please do so you don't miss next week's episode. We put out a new show every single week. We love doing these things, and we love answering your questions as well. And if you, by chance, can make it live to the show, your chat always keeps things nice and lively and always keeps us on our toes, too. And it's fun answering some of your questions or posing hypotheticals and all that stuff. So good to see everyone as always, but we'll see everyone next week.